for those who are newly joining in, I'm just having a mic check now. Please type 1 in the chat box if you can hear me clearly. And remember to log into your MQID so that you can chat with me. Okay, thank you for your response, Chun Hong. And I think there are a bit more. Let me just give you guys a few more seconds. So if you can hear me clearly, remember to type 1. If you want to chat in the chat box, remember to log into your MQID. Thank you, Yu Long. Okay, I think, yeah. So I believe you can hear me clearly now. Great. So let me have a brief introduction about MQ Trader first. MQ Trader stands for Malaysia Quantitative Trader Group. We use quantitative data. We collect large number of data that normally is only available for financial institutions. So we collect all this data and we build into our system called MQ Trader Stock Analysis Tool. And we bring this system and enable it for all our MQ members to use for free. By this, we hope to empower them to make quicker decisions and with greater confidence. And so here's some of the service that we have, the MQ Trader Stock Analysis Tool. And then we have the MQ Affiliate Program, where you can get attractive rewards every time your referral trades with our selected advertiser. Next is our MQDEMY, which is what we are using now. It is an online learning platform where you can learn financial knowledge, and most of them are free as well. So do check it out after this webinar. We also have the MQ event page, where you can get up-to-date information of our upcoming financial events. So you can screenshot this screen so that you can refer back all the QR code and links after the webinar as well. Great, I see more and more response coming in. Great that you guys can hear me clearly. So here's an example on MQ Trade system. This is one of the system under the MQ Trader Stock Analysis Tool. With this system, you can view our exclusive MQ trading signal and also up to 10 market depths, all at one glance. And this is another example on the MQ Trader Stock Analysis Tool. You can get buy and sell signal with just a few clicks. You can also run back tests to test the signal's accuracy. So do check it out if you have not checked it out yet. We also have additional account opening rewards for all who open a trading account with our selected advertiser, including account opening fee is waived. You can get our MQ Trader Premium T-shirt worth up to 249 ringgit. You also get free share transfer from another broker to your new account with the selected advertiser, and also free i3 Investor portfolio integration. So if you're interested to know more, do scan the QR code and send us your contact details so that we can guide you on the next step. For MQ Trader members, don't forget to get your 300 MQ points check-in rewards as well. There are a few steps that you need to do. You just screenshot any part in this webinar, and then you find the post-webinar quiz email inside your inbox. Then you complete the quiz and upload the screenshot into the quiz itself. Then you can get the 300 MQ points check-in rewards. So remember, you need to register for the webinar so that you can get our post-webinar quiz. So remember to register by scanning the QR code here on the screen. And I'll post a few seconds here so that you can take a screenshot as well. Cohen, she cannot hear. So if at any point you can't hear us in this webinar, you remember just to refresh your screen will do. Or you need to check your audio device whether to see it's connected correctly or not. Okay, so I believe all of you have taken your screenshot for the check-in rewards. Here's another advertiser that I want to mention is VC Plus. VC Plus is a global online trading platform. You can trade global stock index options, foreign exchange options, commodity options, and etc. So they support various payment methods as well. It is regulated by authorities around the world. And also with this one VC Plus account, you can access dual platform for free. And account opening is free as well. Totally online, everything online. So do scan the QR code or visit the website to open a trading account with them. And what's more, VC Plus is having a 100 USD welcome credit campaign. When you open a trading account with them, during this campaign, you deposit at least 500 USD into the trading account, you can get 100 USD as welcome credit. So the campaign ends in 31st December this year. So if you want to grab this 100 USD welcome credit, remember to sign up now by scanning the QR code here. You can take a screenshot and sign up later as well. You can also join a VC Plus group chat to get their latest market information for free. So just scan the QR code here and PM them @me, okay, ADDME to the respective team, and then the respective team will add you to the group chat itself. Okay, so by the end of the webinar, we will be having mysterious gifts session. We will be giving out gifts worth up to 249 ringgit. So make sure you stay till the end so that you can grab your chance for the gift as well. And remember, you need to log into your MQID so that you can start chatting with us, interact with us, send inquiries or even questions in the chat box. We will have a Q&A session right after the speaker's sharing. So do remember to log in so that you can chat with us. So about our speakers today, Mr. Kayong, he started trading with just 500 USD when he was 21 years old, and he managed to turn it to 13,000 within 2 years. He was featured on Singapore's CNA Money Mind Young Investors when he was 23 years old. Throughout the journey, he was awarded a few gift rewards as well. And currently, he is a market analyst on various platforms and a head coach at eSmart Academy. So, after all this introduction, can I check if you're ready for Kayong's sharing? Can you type ready in the chat box if you're ready so that I can know that you're ready for it? One Zolnat. Yeah, you're the first one. Congratulations. The most ready one. Okay, a few more ready coming in. Great. So I believe all of you are ready now. So Kayong, I pass the time to you.
All right. Okay. Cool. Thank you for the quick introduction. Okay. So welcome everyone. Again, really great to have this opportunity to share what I know with you guys over here. So today's topic is more towards technical analysis. And the beauty about technical analysis, of course, is it really doesn't matter what instrument you trade, whether is it the local stock market, the US stock market, whether you trade indices, commodities, or even, let's say, the currency market. The beauty about technical analysis is that anything that has a chart with it, that has sufficient liquidity and movement in the market, you're able to then use the technique on technical analysis. So today's sharing over here will be based on what I'm personally using right now. Okay, the whole principles come from Elliott wave principles. And of course, Elliott wave as a topic itself can be very, very complex and confusing to many. Okay, so what I've done is I've actually kind of simplified the essence of it to something that is very applicable and I would say practical. Okay, and that's the whole idea about trading. So just wanted to give you a quick overview because whatever I'm sharing with you really comes from Elliott wave, and the credit goes back to Elliott wave principles here. So today's objective is to, of course, talk about the building blocks of technical analysis. And to me, once you understand Elliott wave principle and you start to look at the charts from an Elliott wave perspective, things kind of look very, very different. In my opinion, it becomes very effective when you come to technical analysis. And today, of course, if we want to dive into the full library of patterns available That's a lot. Okay, so today we're gonna focus on a couple, which we call key patterns, and always highlight that you don't really need a lot in order for you to have trading opportunities, right? In fact, I only focus on 2 patterns personally, and that's more than enough for us to actually trade the market. Okay, and last but not least, today we also cover, how can you, in the shortest time possible, identify certain patterns in the market, and from there it helps you to establish what we call a directional bias, which means when you look at the chart, kind of give you a clue where has a higher probability the market is heading. Is it going to be up? Is it going to be down? Or is it going to be like neutral in a way that you don't really have an extra advantage over the market and you just stay out, right? So at the end of today's sharing here, my objective is to pass on this skill set to you guys. And hopefully, if you pay attention, by the end of today's sharing, you'll be able to then take this and apply it for your trading as well, okay? So a very quick one about myself. I started exposed in the financial market back in 2012. Back then, I was still in uni. And the whole idea is I did not have that idea of, I want to be a trader. I want to learn how to trade, right? Back then in 2012, it's more of just, I wanted to make more money. And I went to search online and I came across the copy trading concept. And that's how I got started, right? And I got really into it, really interested, like what exactly this is. And eventually that's my path, right? Led me to where I am today over here. Of course, throughout this journey, there's ups and downs. I've tried many different methods, be it technical analysis, fundamental analysis, macro, seasonal. I think whatever methods out there that I know of, I've went and tried it out. And I would say that at the end of the day, actually every method works, okay? Of course, each of it would have its own advantage and disadvantage, but at the end of the day, you need to find one that fits your. Yeah, so I was just saying that every method works, okay? And at the end of the day, it's to find one that fits your personality, right? But at the end of the day, I think as a trader or even as an investor, one of the most important principle we need to all really follow is of course risk management. Because for me, one of the biggest lessons that I've learned from the market is to blew up account of a $20,000 account, and that's the biggest lesson that I've learned from trading, right? Is to always manage your risk. And throughout there, after that, I've turned full time in 2015. And since then, I've been very active sharing as well my journey, my experience, what I've learned with fellow traders and investors here. So this is something I truly enjoy, and really hope that today's session can really benefit you guys and, of course, add value to your trading and investing, right? So quick one, these are just some of the photos and physical events that I had before COVID, okay? And of course, right now, I think we're starting to open up a little bit more, and we're soon getting back into physical events, right? I think you get it, right? The difference between physical events and virtual webinar is very, very different. Okay, especially for me, because right now I won't know whether you guys get it or not. There's that lack of connection in a way, right? All I can do is just speak in front of my screen. Hopefully you get as much as possible. Okay, so that's a quick one about me. Yeah. So let's dive into today's topic here, and first start off with understanding what I call the building blocks, right? And I call this market movement, impulse versus correction. What I'm going to share with you today is progressive in nature, which means that you want to be very, very clear as we progress, from part 1, part 2 to the third part. All of these are interconnected, which means that you need to definitely pay attention at the very start, okay? Because if you lose me at the very start, it's pretty hard for you to follow through as we progress, okay? So have that in mind, yeah? Pay attention as we progress throughout. Okay, so what is impulse and what is correction? In a while, I'm going to show you some charts, an example, and of course, hopefully by the end of my sharing, we have some time, we can jump into some live charts to illustrate what we've covered as well, okay? But these are just quick definitions so that you can understand a little bit what are impulses? Okay, so impulses are basically movement in the market that have strong momentum. They tend to move in a very fast manner. Okay, so if you are looking at a chart, we have the price scale and the time scale, right? The vertical axis and the horizontal axis. Impulses are basically prices with huge momentum. The magnitude of price movement is big, where the time element is short. Okay, so it develops very, very fast. Okay, and of course, it's either direction. Impulses can go up, it can come down either. Okay, and then if you take a look at charts over here, I've just basically highlighted two very simple examples. When the market is coming down, you can see those are impulses move, right? Because they are coming down very, very fast. Okay? So this example, if you look at the top left, is actually a chart on Netflix on the daily scale. But the whole idea about technical analysis is that you can use it on any instrument, as I mentioned, or any time frame. Okay, so of course, depending on your trading plan and your trading style, if you're looking at 1 hour, you're looking at 15 minutes, the whole principle applies as well. Okay, more example over here. This is actually on a currency chart. Okay, so you can see here we have on the right hand side of the chart what we call a V shape, where the market came down initially very fast, but it also bounced up very fast, right? So those are two impulses movement. All right, and then of course sometimes in some examples on the chart you're gonna see more of a smaller scale of impulses. Right, so it comes in terms of variation of sizes. Okay, some can be really, really huge, some can be a little bit smaller, but always remember impulses are essentially movement that have strong momentum. They tend to move faster relative to other movement and development in the chart, right? So if you look at this here, those have highlighted, they're quite clear, the price is moving pretty fast. Okay, so those are impulses. Okay, and the other movement that the market can develop is what we call corrections. Okay, so essentially there are only these two types. If the market is not really an impulse, then there's a very high chance it's developing as a correction. So correction is kind of opposite, where the market is basically developing in a very slow manner. It takes a very long time relative to our impulse to develop, and it's basically what we call range bound, right? The market is really not heading anywhere. It's like what we call ding dong, right? It goes up, it comes down, it goes up, it comes down, but not much of a change. Okay, so those are corrections. Okay, so corrections again can be either slanting to the upside, or it can slant to the downside, or it can just go horizontal. So the element of a correction is basically slow moving market movement. Right, so if you take a look at some example over here, you can see those that I've highlighted in gray box. Those are basically corrections. Okay, so you realize that it tends to overlap a lot, right? So price went up a little bit, it came back down, it went back up, it went back down, it went back up, and it's not going anywhere, and it's taking some time to develop in comparison to the impulses that you see on the chart, right? So this takes a little bit of practice, of course. If the principle and the concept is new to you, and you want to apply this impulse and correction, it does take practice. Okay, so have that in mind. It's not an overnight thing, but when you start to see the charts in terms of impulse and correction, that's where the power of Elliott wave comes in. That's where the beauty of it comes in as well, right? Things becomes very efficient and very effective. Okay, so what I mean by this is, okay, if you take a look at this chart here, almost every movement we can put them into a category of either an impulse or a correction. Okay, because at the end of the day, the market is either moving in fast momentum or slow. Okay, so this is again another example. Okay, so every piece of the chart, if you dissect it, is either going to be an impulse or a correction. Okay, and sometimes you can have like multiple impulses after one another. That's common. Okay, so it's not about after an impulse, it needs to be the alternate correction or sort of, but the whole idea is just break a chart down into what we call units, right? Are they impulses or are they correction? Okay. So once you have the ability to do it, right, you are starting to, it's like Lego piece, right? You're starting to build things from one unit and then you mix and match, you get like a combination of it. Okay, and that's what we call the building blocks of market patterns. And if you think about it, you get impulse up, impulse down, correction up, correction down. You can't have 4 different pieces. Okay, and you start to play around with the permutation of it, right? Like you take an impulse up, you mix it with an impulse down. You take an impulse up, you mix it with a correction down. So you mix and match. You can't get what we call 3 core patterns, right? And that's all you have. Okay, and once you're able to see that, that's what I meant by you start to see technical analysis in very different light, okay? Because things become something that is in a finite scope, right? Where you can pre-plan what can potentially happen in the market, because you kind of know that very high probability, these are the few scenarios it can turn out, right? And that's about it. Okay, so that's the power of forecasting. That's the power of pre-planning. So this 3 core patterns essentially builds up from impulses and correction. Okay, so let me introduce them to you. They are, number 1, the first core pattern is a combination of impulse and correction. Okay, in a while again, I'll show you the chart. I'll show you the example. The second category is what we call an impulse followed by another impulse. Okay, and the third category here, I give it a slightly different name. I call it impulse then crawl, but essentially crawl is a corrective move. It's slow. Okay, it's just that it looks different, and therefore to differentiate that, I give it a different name. Okay, we just call it a crawl. So let's take a look at how these patterns look like, right? So the first one here is impulse then correction. Okay, so this is the first core pattern, right? So whenever we see this combination, we know that there is a high probability that we can project where the market will likely head towards. Okay, so in this case here, if you get an impulse followed by a correction, we know that a good 60 to 70% of the time, the market will follow the impulse direction. Okay, and this is the part where we can then establish what I call a directional bias, which means as a trader, I know which direction I want to be focusing on. Okay, and of course, you still need your strategy to get involved in the trade, but direction is like the first thing you need to determine, right? Do I want to focus on the buy? Do I want to focus on the sell? Or do I want to stay out? Okay, so when you see this combination, this is where you get a clear directional bias, and this is where we have a potential trade opportunity. Okay, so how it looks like, right? So if you take a look at some of the case studies that have happened in the past, okay, so these are a combination of what we call impulse then correction. Okay, so you see the yellow line up, which is an impulse, and then you have the gray box, which is a correction. And every time this happened, the market follow through in the direction of the impulse, right? So the impulse is up, and therefore the market just keep going higher, right? Every time you have an impulse correction, it goes up. You have an impulse correction, it goes up. Okay, so in this case here, we have 2 sets of that combination, and both work perfectly. Right, it works in either direction. So over here we have a downside, right? So you have a very strong impulse move to the downside, followed by correction. The market move lower, and then same thing, right? It repeats. You get an impulse, you get a correction, it continue to move lower. So in this example here, what you see is actually 3 sets of impulse then correction. Now, some of you who have a little bit of experience in technical analysis would be able to see it as a flag pattern. Okay, so that is essentially also what we call a flag pattern. But in terms of Elliott wave, there are variations to it, right? You have the regular flag, you have the flat, you have the expanding flat, you have the running flat. So I kind of simplified that, and we call it corrections. Okay, so when you kind of see this, you know there's a high chance of where the market is going, right? Obviously, nothing is going to be 100% in trading. But this kind of give you a good 60 to 70% probability every time you see a pattern like that. Okay, so what this means to you as a trader, of course, you know, we don't look at hindsight, right? We don't look at the past and then say, oh, I could have taken this, I should have bought this, and things like that. But what this kind of historical pattern tell us is that in the future, if you kind of see something similar to an impulse correction, then you jolly well be focused and you know there's an opportunity that's setting up, right? So what I mean is this, right? In the future, if let's say you look at the chart and you saw this combination, right? So you saw an impulse move to the upside that's very strong, and then you start to see, oh, there's a correction that is developing. So you have this combination of an impulse correction. Now, at this point in time, it becomes very clear our directional bias is going to be bullish, which means the direction I'm going to focus is definitely just on the upside. Okay, now how I'm going to get involved in the buy trade, again, that boils down to the details of what's your strategy, what's your trading plan. But at this point in time, it becomes clear there's a higher probability that you're going to get it right if you focus on buying instead of selling. Okay, so that's the beauty of it, right? I mean, same example, opposite direction. If you see an impulse correction, in this case here, then we know, okay, there's a very high chance the market is going to continue lower, and I want to be focusing on sell opportunities. Okay, so this is the first combination, right? Something that, again, it builds up from the whole understanding of impulse and correction, and you realize that we don't really need a lot of like indicators. We don't need to really look into like the past, you know, what is a pattern and things like that. But what we are focusing here is the recent price development. Do we have an impulse and correction, right? Basically, that's the question I'm asking. How is price developing right now? If you can see this, we have a potential trade setup. Okay, so that's the first. Now, the second category is what we call an impulse, or often I call it V-shape. Okay, because they tend to look like a V-shape pattern. Okay, and every time if you see, you know, a V-shape or an impulse, and that's about it on your chart, you want to stay away from the market. Okay, because it doesn't really give you any probability or any edge over the market. Okay, it's basically like 30%, right? So you kind of like have a small percentage of getting the direction right. So that's not something that is favorable to traders. And whenever we see that, we just stay away from the market, give it more time. Eventually, I always say the market is going to develop into something that becomes clear to us, and then only we trade it. Okay, so how does V-shape looks like? If you take a look at this example that I've boxed up, you can see that initially we have a very strong move to the downside, and then a very strong move to the upside, and then after that a very strong move back down, right? So it can't give you that what we call whipsaw, or you get a very huge volatility move, basically one impulse after another. Those are what we call V-shapes. Okay, and every time you see something like that, you stay out, right? Because you don't have an edge. Okay, now again, you know, if you look at the current market development, if you look at the chart, and then immediately what you just see is just one straight impulse, whether is it up or down, and then that's about it. Nothing else that's developing, just a very strong move that done. Okay, example is, of course, you know, if you take a look like yesterday, if you're following the Fed, right, equities market came down quite strongly. After Jerome Powell, I can kind of mention that they're going to be very aggressive in hiking. The equities market tanked, right? So if you look at like S&P from yesterday, basically what you get is just one straight down move, right? So those are what we call just an impulse. That's nothing. Okay, so same thing in this example on this chart, we just have one straight move up. Okay, whenever you see something like that, I always say give it more time. You don't need to rush in. Okay, because what's going to develop next, whatever it is, there's a high chance is not going to be favorable to you, right? To you means not only your capital, your money at risk, but also in terms of your psychology and what we call your mental capital. Okay, because if today you enter a trade and then it's not moving, and then every day you get anxious, you get worried about it, you know, as the day goes by, you know, you get a bit of profit, you get a bit of loss, you get a bit of profit, you get a bit of loss, you get frustrated. Okay, things like that is going to affect your other trades, right? Or I would say things like that might also affect like subsequently how you're going to perform your analysis and things like this. Okay, basically it just eats into your mental capacity. Okay, and you don't want that to happen, right? So that's why I always say when you see an impulse, the best thing to do is just stay away. Okay, same thing over here. If you just get one strong drop, stay out. Okay, so how long do you stay away from the market? Is you stay until you see either of the other patterns that we talk about, right? So just now at the very first pattern, we talk about impulse correction. So you wait until you see that, okay? If not, then you wait until you see the next one that we're going to talk about, okay? Which is what we call a crawl pattern, okay? So what is a crawl? Okay, crawl, essentially the element of it is also a correction, but it's slightly different in its visual, right? In a while, I'm going to show you an example. Crawl over here is a potential reversal setup. Okay, so whenever we see this pattern, we see this combination, we want to focus on the reversal. Okay, so which means we look for the opposite direction of the impulse, or some traders will call it a counter trend trade. Okay, so if today you are not a counter trend trader, you are a trend following trader, and then you spot a pattern of a crawl on your chart, then it tells you, okay, be careful. Maybe the market is going to pull back a little bit. It doesn't mean you need to trade it, okay? But understanding the probability of this pattern kind of able to protect you from entering on unnecessary trade as well, if you're purely a trend following trader, okay? So how does it look like? Okay? If you take a look at this example here, why I have this terminology of crawl in it, right? It's essentially describing how the market is moving. Okay? So if you focus on like the yellow line, that's an impulse, right? So the market moves up very fast. And then as it starts to progress, we start to see that momentum is lacking. The market slowed down as it progresses higher. And there's elements of overlap, right? It goes up, it comes down a bit, it goes up a bit, it comes down a bit, it goes up a bit, it comes down a bit. The direction is still going up, but there's a lack of energy, right? So that's what I call like crawling to the upside. So we just call it a crawl pattern. So this kind of suggests to you, all right, the market is lacking energy, is lacking momentum. And when one thing is lacking energy, eventually there's a higher probability of a reversal. Okay, and that's how the principle comes about. Okay, now if you're familiar with some of the conventional and traditional technical patterns, some people would call this a wedge, or in Elliott wave terms, we call it diagonal. Okay, so these are some of the conventional naming of the patterns. For me, to make it really simple, I just call it crawl. Okay, but they're essentially the same thing because the visual perspective of it looks the same. Okay, so if you take a look at here, this example, we have an up crawl, we also have a down crawl. Okay, so every time you see this, again, you have a good 60 to 70% probability that the market is going to reverse, right? I just want to remind and highlight, it's not about 100%, it's all about high probability. Okay, so this is the third pattern. Now for me, I only trade this two, and it's more than enough for me, right? So a lot of times pattern traders would start to talk about like head and shoulder, double top, double bottom, and then you have like triangle, you have wedge and things like this. Those are all valid, okay? Or I would even say those are all slight variations of also impulses and corrections. And you don't want to overcomplicate stuff, right? So if today you are fairly new to this principle, then my suggestion is, again, keep it simple. Focus on the first pattern, which is impulse correction, and then this pattern here, which is impulse crawl. Okay, so again, what this means is that in the future, okay, if you see something similar like that in this situation where you have an up move and then the market starts to crawl a little bit to the upside, very obviously it's lacking momentum. This is something that suggests, okay, a potential reversal is coming. So if today you are trend following, then you don't buy. Okay, when you see this, you just be careful, you don't buy. If you're a counter trend trader, then this becomes an opportunity for you to focus on a sell. Okay, I hope you are following me and you're getting this, right? And then, of course, the opposite direction here, it came down very fast and then it starts to slow down. Okay, it's still going down, but it's lacking momentum, right? Same thing here. We're looking for a reversal, which means, if you're a counter trend trader, that's your buy opportunity. If you're trend following, then be patient, be careful, don't sell it already. Okay, so again, all this can be applied in the currency market, in the local market, in the US market, in the indices, or even in the commodities, right? As long as there's a chart, you can apply it. Any time frame that you're looking at, the principle still stands. Good. Now, just to add one more layer of what we call a confirmation, okay, to help you a little bit in the crawl pattern, I personally add in the RSI indicator, right? So this is what we call relative strength index. It's basically an oscillator, right? So if you're more familiar with, let's say, stochastic, okay, they kind of function similarly, right? Or you look at maybe some commodities traders look at CCI, right? Kind of similar idea. Yeah, oscillators family. So RSI here, essentially the formula kind of tracks price momentum. Okay, and that's what we are using, right? We're using it together with a crawl pattern to kind of give us that confirmation. Now, the default setting of RSI is always 14 period, 30 oversold, 70 overbought. I just personally like to change the period to 7, and the extreme zone, I just push it a little bit further to 20 and 80. Okay, it's not a magic formula. It's just, for me personally, I feel that this gives me clearer signals. Okay, so that's all it really matters. Okay, so how I use it, okay, I use RSI with the principle of divergence. Okay, so divergence, as the name suggests, is basically when things are going in opposite direction. Okay, so what we are looking out for here is more of a regular divergence, which is easier to spot, and regular divergence often indicates a reversal. Okay, hidden divergence is another principle. Most of the time, hidden divergence indicate a trend following. Okay, and if you're putting this in the context of Elliott wave, when we are identifying running flats, we tend to use the concept of hidden divergence. Okay, but today we don't want to go into running flat because later it confuses you guys. So we're gonna focus on regular divergence. Okay, so how does it look like? Now, if you take a look at this here, at the top, of course, is your price chart. At the bottom, that's where the RSI is. You can kind of see very obviously the price is heading higher, but our RSI is actually not going higher, right? So one is going up, one is coming down. That kind of give you that divergence. Okay, and this is what we call a regular divergence. So what this means is that the market is lacking momentum. So again, this suggests that a potential reversal is coming. Combine that with a crawl pattern. Okay, that's where two things comes together, right? So whenever we look at a crawl, we usually just pull up our RSI and see, okay, is there a divergence? If there's a divergence, that gives us a higher probability. Okay. Now, if there's a crawl but there's no divergence, then maybe we want to be a little bit cautious. Okay, so that's the whole idea about it. Similarly, if the market is coming down and we have a divergence, it works the same way. Okay, so we are basically looking for a reversal. Good. And then this is just a very quick introduction to hidden divergence. The principle is the same. You kind of get different direction, but in this case, the visual perspective of it is slightly different. Okay, so you can see over here, price is making higher lows, but RSI is actually making lower low, and the way we kind of track is slightly different, right? So this is how hidden divergence work. And again, it's a trend continuation, which means in this case here, we're looking for more upside on price. Okay, and this is another opposite example. Whenever we see this, then we're looking for more downside, right? So that's basically hidden divergence. Okay, but I don't want to spend too much time on that. Okay, so regular divergence is more important. Cool. Okay, yeah. So over here, I know traders who trade off just based on divergence and it works for them, but I don't just trade off divergence. Okay, I combine it as a confluencing factor with the crawl pattern. Okay, so I just use it mainly for like what we call confirmation. Do I get a divergence when I have a crawl? Okay, if I have, then perfect. If I don't, then I just be a little bit careful on it. So far so good. Okay, yeah. So this is an example of it. So we get a crawl, we have a divergence, and therefore I'm expecting a reversal soon. Okay, and that's something that then I'll be looking for buy, or if today I don't want to buy, at least I won't be selling into a pattern like that. Cool. So this is how it happens. Okay. I hope so far so good. Okay. I'll take a couple more minutes to just jump into some live charts to show you the process of it. Okay, and then we'll open up for Q&A and answer some of the questions that you guys have. Okay. Now, I want to first highlight the fact that obviously this is not just about looking at a pattern and then that's the end game of it. Okay. But that's the building blocks, right? That's what we call the essential element to get started. Okay, because moving forward, you need to add more layers onto that, like what I call context. Okay, and then of course, some of you might be very familiar with Fibonacci's, so we add that element in as well. Of course, key levels, like some of you might call it support resistance, supply demand. Those are essentials as well. Okay, so those are building context, right? And then because of time constraint, there's the other aspect, which what we call expectation as well. So for example, in Elliott wave, we can't always expect the market to develop in waves of 3. And of course, there's some expectation on how you deal with it. Okay, but today, I think the primary objective here is if you can take away that ability to identify impulse and correction on a chart, okay, and then put them into combination and then help you to establish the high probability direction. I think that's great, okay, because that kind of start to build up a whole different way of how you look at charts. Okay, just to very quickly show you some example over here. Okay, so if you look at, this is a US stock, right? So if you look at AMD, later I'll jump into maybe some currencies and commodities. If you look at AMD, right now we have the pre-market open price, but right now what you can see is as the market is right-hand side, most current market price already that we get, we kind of get a pattern that looks something like that, right? So we have a very strong move to the downside, we get a correction here. So we have this combination, and as we have highlighted, every time you see this combination, you have a good probability of the downside. Okay, and therefore we can't expect the market to keep moving lower, right? And we kind of very clear establish our directional bias. I want to look for sell. I'm not interested in the buy. Okay, so over here, the first question you always ask yourself to apply this principle is, ask yourself, how is price developing, fast or slow? Okay, so if you take a look at this one here, you ask yourself, how is price developing, fast or slow? I think I would say 99% or even 100% of you would say that's slow, right? And that basically answers the question, is it a correction or impulse? Okay, so if it's slow, it's correction. Then now that you have established this is a correction, the next piece before it, you just ask the question, how did price comes down, fast or slow? So I think again, 99 to 100% of you would probably answer fast, right? And that's impulse. So that can answer the pattern. You get an impulse, you get a correction, you expect downside. Okay, pretty straightforward, right? So for those of you who are looking at AMD, that's the direction to focus. Okay? Then if let's say we, just jump, for example, like example on Boeing. Okay, this is Boeing company, right? The airlines. So you ask yourself again this question, right? How is price developing? Now, some charts at some point in time may not be the clearest for you or even for me, okay? And that's a fact in the market, right? Nothing is going to be like always picture perfect. So when things are not the clearest to you, the easiest way to deal with it is always move on, okay? Give it more time, move to the next chart, right? So if you just do a quick comparison, AMD, I believe everyone will be very clear, right? This pattern here. If today we talk about Boeing, right? How did price went up? There might be, I'm very confident there will be a mixed answer, right? Some would say it looks fast. Some would say it looks not that fast. Some would say, I don't know, not sure. Okay. So when you can't get that kind of element of, this one, like not very clear, it's just telling you it's not clear. Okay. And acknowledge the fact that it's not clear and move on, right? So for example, like Boeing is not a chart that I'm going to focus on at all. Okay. And then maybe we jump another one. GE, General Electric Company, right? So how did price move recently? This one I think quite clear. It went up very strong as an impulse, and then that's about it. Okay, yes, it starts to show sign of maybe coming down a little bit, but this is too early, so small, not enough, right? So what you then analyze over here is we just have an impulse. That's it. Okay, so when the market ends off as an impulse, you don't move, you do nothing. Okay, because there's no probability as to whether is it going to go up, is it going to come down, or where is it going to go. So you stay away. So far, so good. Okay, yeah. So that's on the stock market in the US, right? So I'll just very quickly also show you maybe some FX side of things. Okay. So over here, if you take a look at this here right now, okay, just yesterday we have the FOMC and the dollar strengthened, right? So what happened to the euro? Okay, the euro actually from yesterday to now, it just came down pretty fast. I think, you know, if you ask yourself how the market came down, again, majority of you, in fact, all of you will probably say fast. So if this is fast, then what happens is you don't sell it now. There's no reason to sell now, right? Because it's just an impulse. Now, if today the market continue to develop and from here it builds up a correction, okay, which is gonna take time, right? It's gonna take maybe a couple of days. But let's say next week you come back, you see the chart, you see this, then you know there's a very high probability this will continue going lower. Okay, and that establishes your directional bias. But for today, nothing, right? So this part here, which I'm doing, is what we call forecasting, which means I'm already pre-planning a little bit into the future, moving forward, what I want to see. If the market gives me that, I have a trade. If the market doesn't give me that, I don't trade. Okay, so to illustrate that principle as well, if today the market continue to move lower, but it starts to slow down and it forms a pattern like that, I'm no longer interested in selling, but I'll be more interested if is this gonna be a counter trend reversal trade. You're following me? Okay, so again, this part here is called forecasting. Okay, it's like pre-planning, moving forward. If this happened, I'm gonna do this. If that happened, I'm gonna do that. And the ability to do this all boils back down to understanding the building blocks of technical analysis, right? Impulse and correction. How can the market develop? Is it going to be impulse? Is it going to be correction? It's a mix and match, right? So at the end of the day, what I'm doing over here is I'm plugging one unit, put it in. If this happened, this is what I'm going to do. I take another unit, I plug it in. If this happened, this is what I'm going to do, right? So I'm just basically pre-planning ahead. If the market happened in a situation that I like, I have a trade. If it's not, I stay away. Cool. Okay, now this can be applied in multiple time frame, right? So what we have done so far on this example here is a 4-hour chart. Okay, so if today you go to a daily chart, okay, you can see that this here can be a flag pattern. Okay, now I don't want to dive too much into it, but you can clearly see this one here is a 3-wave development. 1, 2, 3. Okay, so that's again that element of Elliott wave where we always forecast and expect 3-wave. Okay, this is like a classic example, right? So if that's a 3-wave, then this again suggests that this can continue lower. So for those of you who are a little bit more experienced in technical analysis, you probably heard of this term called multi-time frame analysis, where you look at different scale of a chart, okay, which is what I'm doing now as well, right? So we have a 4-hour chart, we go on to the daily, and when 2 of this time frame also aligns with a same direction, then obviously the probability is going to be a little bit higher, okay? So that's also a little bit on the context, okay, where you are asking yourself, all right, we have this pattern. Then you further ask this question, where is this happening? Okay, if it's happening based on a larger scale, we also have some confluencing, some confirmation. That's best. Cool. So I hope that helps. If you take a look like indices, okay, S&P, right? Yesterday, what happened? The market came down very sharp. So what do? You stay out. Okay, if moving forward you see a correction here, you can continue to expect the S&P to continue falling. All right. Can this apply to commodities? The answer is yes, right? So gold. Okay. Now gold here yesterday came down pretty sharp as well. So we basically end off with an impulse. Okay. But go here, I just want to also illustrate a little bit to share with you a bit of the context part of analysis. Okay? So obviously, I think this is quite clear for everyone. We have a support line over here. Okay, again, it doesn't need to be like pinpoint to the dot, but you can see the market kind of bounce up, and we're back here. Right now, a typical support resistance trader is going to start to look for a buy at this point because we already tagged the support. But for me, I'm not trading the support and resistance by itself. I'm actually using it as a context. Now we are at a very important level. If the market does a crawl pattern here, then I'll be interested in the buy. Okay, why? Because we have support and we have a crawl, which suggests a lack of momentum and a reversal. However, if today we get a correction pattern here, then I'll be actually more interested to see if we can get a breakout trade to the downside. Okay, because that suggests an impulse correction and downside. And if today I look for a breakout trade to downside, I'm not only trading this pattern, I'm trading the breakout of this support. Okay, so that's where the context built in. Okay, now in the event we don't get either of this, and what we get is maybe tomorrow the market just decide to bounce up strongly, we get a V shape. Great, this support works, but I don't jump in here. I wait for correction to develop, then I look for the buy. You follow the top process, right? So what I'm doing over here actually starts off with understanding of impulse and correction, but I use that to start building up more stuff in my analysis. Hopefully that makes sense, yeah? Okay, so again, that's how it works. Does it work on cryptocurrencies? The answer is yes, right? So if you look at Bitcoin right now, to be more specific, on the 1 hour chart, okay, we are seeing a little bit of this pattern where we get a very strong push and then we kind of get a little bit of a correction here. Okay, so what does this tell you? Potential direction to focus is upside. Okay, now I'm not saying you go and buy Bitcoin. I'm just saying that you have a direction that you can focus on. Okay, because trading crypto is a whole different ball game. Okay, I just want to also highlight, some different techniques that you can layer on. Okay, but it boils down to the foundation of impulse correction, right? So over here, if you're using a little bit of what we call a channeling technique, you can draw in a channel for the correction. Okay, and then in terms of Elliott wave here, we add in that 3-wave expectation. Okay, just to show you a complete set of that. We use a little bit of fibs here as well. Okay, something like that, right? So what this suggests is that if the market were to come down towards this zone here, where we have the channel, where we have the 3-wave, where we have the Fibonacci, and if we get a crawl, okay, and if you want to add in the RSI and you get a divergence, like multiple things all stacking up together, the probability is very high for this to continue bouncing up. All right, so I just want to let you see the progression, right, of this whole process. Now, it doesn't mean that immediately it drops here, you buy, right? Because if the market comes down very fast and an impulse move like that to this area, there's no reason to buy. Okay, as the saying goes, right, you don't catch a falling knife. Okay, I just want to highlight that this here, like support and resistance, is not really a good idea to just say, oh, it touches that level, let's buy it. Okay, levels like that I like to call key levels, which means areas that you definitely want to pay more attention to it, and ask yourself this question: how is the price developing at those areas? Okay, do you get a directional bias that is very clear around those areas, right? So I'm always asking those kind of questions. Good. Yeah, so I hope so far so good. Okay, yeah, so I'm also tracking the time here, right? Because I want to open up a little bit more time for Q&A. Okay, so actually those are the content that I've prepared to share so far. Okay, for today's sharing here, based on the time that I'm given as well. Hopefully you guys actually took away some learning points, okay, and hopefully what I share with you today is able to also help you in your technical analysis. Okay. So with that, I'm going to pass the time back to the moderator and for her to actually moderate the questions, and then we'll answer some of those questions that you guys have. Yeah.
Yeah, thank you, Kayong. Thank you, everyone, for participating as well. I believe your sharing has sparked lots of interest in today's webinar. Let me just share my screen. Okay, so for those who are interested in trading or joining VC Plus, do join now because they are having a big 100 USD welcome credit campaign where you deposit at least 500 USD and you can get 100 USD as a welcome credit. So do scan the QR code here and you can sign up for free. You can also join VC Plus group chat to get their latest insight for free as well. So scan the QR code here and say PM, add me to them, and the support team will add you to the group itself. For MQ members, remember to send your screenshot, upload your screenshot into the quiz itself to get your check-in rewards. And we will have our mysterious gift session very soon after the Q&A. So do stay tuned for it so that you can get your chance to win our gifts. So let us start our Q&A session now. Okay, Kayong, I think the first question is from Ko Wen Shi. She asked how to differentiate crawl and correction. Maybe you can elaborate more on that.
All right, cool. Okay, maybe I will see. Give me a while. Yeah, then maybe I'll show some charts. Then it becomes clearer.
Yeah, you can share your screen.
Okay. Okay, just to very quickly share, this is actually how it looks like on VC Plus platform as well. So pretty similar in terms of the charting. Okay, so this one here, just very quickly show you what is a correction first, and then I'll find a crawl pattern that is clear, and then we'll talk about the difference. Right? So if you look at this here, right, you can see this drop. Okay, you follow my mouse cursor, yeah. This drop over here is fast, and then this moves sideways. Okay, so that is what we call an impulse correction. Okay, so the idea of it is the correction part is the market is moving slow, but it's moving in a slightly opposite direction of the impulse, right? Because this impulse is coming down and the correction is slightly slanting to the upside. So that's kind of what we call impulse correction. Okay, the correction direction is slightly opposite of the impulse. Okay, let me find a crawl pattern. Okay, I may not like remember exactly which one, but I think pound yen has recently. Okay, on a higher time frame perspective. Okay, because this one I think we shared with the VC community on Tuesday, so I can't remember this. Okay, now it's on a daily scale, but 4 hour you can actually also see it, but daily is a little bit clearer right now. So you follow my cursor again. Okay, so if you take a look at this low here, the market went up. Okay, so this move up is rather fast, and we categorize that as an impulse. And then what's happening next is that the market continue to climb, but you can see that this move to the upside from here to here, it slows down. It's not going as fast as like from here to here, right? So that's what we categorize as a crawl. It's still a correction, but the direction of that move is actually the same as an impulse. Okay, and that's where we just give it a different name to differentiate that two combination. Okay, so this is how it looks like, right? On the 4 hour chart, you can see from this move up initially quite fast, and then from here to here, you put in your RSI, you can also find divergence on it. Okay, so I hope that clarifies a little bit on it.
Thank you, Kayong, for your sharing. Yeah, I think that's quite clear enough. Okay, so the second question is from Jeffrey Chung. So he also asked how to judge crawl. And the second question is, can you use the signal to any signal to trigger it?
Oh, okay. The trigger signal, I believe, is more like you're asking entry technique. Generally, maybe broad base of answering that technique, right? I always say there are two types of entry or tree, right? I mean, if you're actively sitting in front of a computer, then you can do market execution, you can enter a market at this current time, you know. But most of the time, we don't really sit in front of a computer to like actively go in, come out, go in, come out. So we call it pending orders. And pending orders, they're generally two types, right? We have the retracement, and then we have the breakout. Okay. So just to very quickly share with you this chart so that you can see the one that we talk about. Okay. Yeah. So I'll just share this screen back here. So this is on pound yen, right? So why I'm coming back to pound yen is because this is one of the chart that we shared with the VC community on Tuesday. So kind of remember this very, very clearly. This technique here is called breakout. Okay. So if today you're looking at a reversal setup, which is a crawl pattern, it's always more conservative to trade a breakout, right? So the whole idea of a breakout trade is you're waiting for that kind of confirmation. You're waiting for price to move in that direction that you want, and therefore we call a breakout, right? So if you're looking at reversal, you know, we usually use a breakout entry. Now this one here, what we did was we're basically having this trend line. Okay, just off the magnet, we have this trend line, we have this crawl. So we're essentially just waiting. If the market break off this trend line, we can't get a confirmation that it wants to continue going down. Okay, so that's a breakout technique, right? And then you also have what we call a retracement technique. Let me show you one example. Okay, now Aussie CAD may not be very clear right now, but what happened in the previous before it happened, okay? Retracement technique, we use a little bit of fits, okay? Because we all know like, okay, when the market pulls back, where would it likely head towards? Okay, so if you take a look at this here on Aussie CAD, just visualize with me. Before this move here, we have this impulse, and then we have this little sideways move. Okay, so a retracement technique, you need to have a way to identify the areas in which you expect the market to go to complete the correction. Okay, so in this case here, we're using a little bit of Elliott wave principle of fits, which is the 50 and the 618 Fibonacci. And then we also observe we have that 1, 2, 3, that 3 waves. And this is the area in which you then can look for a retracement entry. Okay, so these are broad base, or I would say generic ways of how you can differentiate your entry techniques. There are more than that. There are some traders who uses candlestick formation like pin bar rejection, engulfing candle, etc. At the end of the day, you get, again, I always highlight you need to go back to what fits you, right? Because some traders, they're very comfortable with setting a pending orders at maybe 50, 60% Fibonacci when the context is right, and then they just leave the orders there. Some traders would prefer to say, okay, I'm looking at this area. I know what I want to see. I want to see a pin bar. I want to wait for the candle to close before I execute the order. So there's no like right answer to entry. But from here, understanding you have generally these two types of pending, you need to then go and explore it. Use a lot more on the breakout instead of a retracement, because that's my style. Hopefully that can answer the question.
Yeah, so basically it depends on the trading style of each person.
Yeah.
Okay, so I think due to time constraint, this is our last questions. I believe there are more, but we have to keep the questions short. So the last question is from Momo. He or she is asking, since divergence is normally looking for momentum, why a hidden divergence means a trend continuation? Yeah.
Okay, that to answer that, there is no there is no like academic answer to it, right? It's not like science behind it, but it boils back down to technical analysis. At the end of the day, we are looking for patterns that are repeatable and what I call reliable. Okay. When we talk about patterns, a lot of times people will only think about price pattern, right? Like head and shoulder, double top, etc. Yeah, those are patterns. But if you're talking about indicators trading, actually at the end of the day is also patterns, right? Because for example, if you're talking about moving average crossover, that strategy itself is also about pattern. Okay, whenever the market line the MA cross, you enter a trade or etc. Okay, so coming back to like RSI indicator and spotting divergences, right? Whether it's a regular divergence or hidden divergence, it's all also about pattern. So when we talk about pattern trading, the two key elements that are very important for it is repeatability and of course reliability. Okay, repeatability means that the pattern tends to repeat itself sufficiently in the market for you to have the opportunity to trade, right? So if a pattern only happens like once in 10 years, then it's not effective because you then need to wait until 10 years. So repeatability is important. Reliability is also important, right? So reliability is basically the accuracy of it. So if a pattern always occur, but it's only about 50-50, right? So it's almost like sometimes you get this, sometimes you get that. It's not reliable, okay? Because in the future, if you see a pattern like that happen again, you have no idea whether you want to buy or sell. Okay? So when we talk about regular divergence or hidden divergence, when we come back to the pattern concept of it, right? Again, repeatability and reliability is that whenever we see a hidden divergence, okay, we can't spot and know that there's a higher probability of a trend continuation. It's not 100% all the time is going to happen. Let me just quickly bring out, let's just see if this is still there, okay? Because I remember, okay, let me share with you this, okay? So this is a chart on a dollar yen, okay? So we kind of can see that over here we have a bit of a hidden divergence. Now, we don't see a lot of hidden divergence in the market. It's not easy to identify as well, okay? But if you take a look at this point here and this point here, the market came down, but this one went up, right? So again, that kind of suggests the impulse is down. So this kind of suggests that this would likely continue to the downside as well. Okay, is how the pattern works, because most of the time when we see that a combination of a hidden divergence, there's a higher probability it does trend continuation. Okay, it's not like all the time it's going to do it, but there's a high probability it does that, and therefore when moving forward in the future we see it again, we kind of expect the market to do it that way. Hopefully that helps, right? I mean, I don't have an exact scientific answer as to why, but that's the logic that I base on, and that's the logic that I understand when I look at technical analysis. Hopefully that helps.
Yeah, so historically, this has been the way for hidden divergence, I would say.
Yep.
Yeah, so that's all for the Q&A session for today. Thank you, Kayong, for your sharing. So once again, I just want to remind that VC Plus has a welcome credit campaign. So do sign up now so that you can join the welcome credit campaign that ends in 31st of December this year. So do sign up now if you are interested. Okay, so we are starting our mysterious gift session now. remember to log into your MQID so that you can send us your answer in the chat box. So before I start, I just want to say a very good thank you for this Kayong, and I believe all our viewers have learned a lot from you today. Yeah. Okay, so are you ready? Make sure you get ready with your chat box. Sign in everything clear. Okay, let's start with our first question. So the first question is, in VC Plus welcome bonus campaign, how much credit can you get when you deposit 500 USD and above into the new VC Plus trading account? A, B, C, or D? I just showed you, I think, one previous slide ago. Okay, so the answer is D, USD 100. US dollar 100. I think the first winner from my side is Victor CH and Ko Wen Shi. So for winners, please use the Google form on the screen to send us your contact details so that we can arrange for the gifts for you. So let's give our winners a few more minutes so that they can send us their details. Victor CH, okay, Wong Chun Hong. Again, please use the Google form. Okay, next. What are the two market movements that Kayong mentioned just now at the very beginning of his sharing? Is it upward reversal, impulse correction, upward, downward, fast and slow? What movement that Kayong mentioned at the very beginning of his sharing? I see a lot of answers coming in. Okay, the correct answer is impulse and correction. Let us have a bit of time to sort out the winners. Answer is B, impulse and correction, and you can use a few combination that Kayong mentioned. If I'm not wrong, it's impulse correction, impulse, and impulse and crawl. Okay, so the winner is Wan Zulnet and Ko Wen Shi. Remember to use the Google form to send us your contact details. And if you don't mind, you can send us the contact details in the chat box as well. So winners, remember to use the Google form. And while waiting for them, let's continue to the third questions. So last question, if we see impulse then correction pattern, what will probably happen? A, the market will continue in the direction of the impulse or in the reverse direction of the impulse. Which one? We got only A and B for this question, so it should be very easy. Okay, a lot of answers coming up. The answer is A, the market will continue in the direction of the impulse. So let's wait a little while for us to collect the numbers, the names of the winners. So basically, if I'm not wrong, Kayong is in here as well. So when you see impulse and correction, most probably the market will continue in the direction of the impulse. And so our winner for today, for this question is Jeffrey Chang and Khairul Anwar bin Shaharuddin. So congratulations once again. Please use the Google form on the screen or in the chat box to submit us your contact details so that we can arrange the gifts for you. And while waiting, don't forget to sign up for VC Plus if you're interested in the USD 100 welcome credit. You just need to deposit 500 USD and above to get this welcome credit. And it ends in 31st of December. So do sign up quickly so that you won't miss it out. Once again, a very big thank you to all of you who participated in our webinar today and made it a successful one. MQTrader will be organizing webinars at least once every month. So remember to like and follow us on our Facebook and Instagram or social media so that you won't miss out on our updates. So this is how our MQTrader Facebook looks like. Remember it, go and like us and follow us so that you won't miss out on our webinar. And here's our i3 Investor and also MQ Chat. You can follow us and like us on MQ Chat and i3 Investor, again, so that you can get our updates as well. We will share articles on financial markets, on financial insights from time to time. So do like and follow us on this social media. Let us just give our winners a few more seconds. I think we are lacking of 2 winners, Khairul Anwar and Wong Chun Hong. Remember to use the Google form. I'll just quickly show you the screen again. Remember to use the Google form or the link on the screen to submit your contact details so that we can arrange the gifts for you. By the end of the webinar, if you have not yet submit, we will unfortunately have to skip now. So do submit your contact details using the Google form for winners. We are looking Kowenshi and Anwar. Kowenshi and Anwar. Remember to use the Google form to submit your contact details. Yes, Chun Hong, I saw you have submitted already. Thank you for your response. Yeah, so Kowenshi and Khairul Anwar, we'll give you a few more seconds, a few more minutes. And for those who are interested in signing up for VC Plus, you can always refer to the links on the screen or in our chat box as well. And remember, you can PM VC Plus support team, add me for them to add you to their support group to send their latest insight for free. Khairul Anwar, maybe you can copy the form, the Google form link. You can copy and paste in your browser so that you can use it. I've sent the Google form link only, so you can just copy the whole message so that you can paste it in your browser. For everyone, thank you once again for staying through the whole webinar. I hope you have learned something today, and I wish you all the best in using MQTrader system, VC Plus, and etc. And good luck in your trading journey. I will turn off my camera now, and the webinar will be live for a few more minutes so that you can refer to the links in the chat box, and also for the winners to send in their contact through the Google form. Once again, thank you for your participating on our webinar today and making it a successful one. This is Casey from MQ Trader. I wish you a great week ahead.
Thanks for watching.